Hello and welcome to Beacon Pointe's Fiduciary Point of View webinar series. As a quick introduction, this is Doug Igel, the Director of Retirement Plan Services at Beacon Pointe Advisors. Beacon Pointe is a registered investment advisory firm located in Newport Beach, California that currently manages over $9.5 billion in assets. Today we'll be covering how to engage younger employees in your retirement plan, whether 403b or 401k. According to Wikipedia, demographers and researchers typically use the early 1980s as starting birth years and the mid-1990s to early 2000s as ending birth years. The majority of researchers concludes millennials differ from both their generational and cohort predecessors and can be characterized for a preference for a flat corporate culture, an emphasis on work-life balance, and social consciences. With that said, how do we get this generation to invest in their 401k plans and 403b plans when many times their goals may not align with that of the plan? Our speaker joining us today is Jay Kim. Jay is the Senior VP Client Advisor for Neuberger Berman. Founded in 1939, Neuberger Berman is a privately held asset management firm that manages over $280 billion. Jay, maybe you can give a quick overview of what some of the challenges millennials face today.
Thank you, Doug. Definitely. I've been working with Doug for over 8 years now, and I have been in the retirement plan industry for 20 years, and take just about 15 minutes or so to review the content and provide insight on how to get younger employees engaged and saving for retirement. And as Doug mentioned in his introduction, millennials, the definition is typically born from 1982 to 2000s. And in doing some research, you'll see that millennials aren't, as you may see some articles killing everything from housing to traditional retail stores. When you look at some of these numbers, they might be surprising in that this generation has already started saving for retirement with 60%. But the perspective of having to engage millennials and thinking as an employer for recruiting and retention, there is a higher likelihood that this generation would switch employers for better retirement benefits. Now, they do have some challenges, of course, as many of us probably did when we came out of college, but 7 out of 10 new college graduates leaving school with student debt. So that's definitely weighing on their decisions on where to put their money, where to spend, and where to save. I thought it was interesting that 63% of millennials don't have a single credit card. So they are definitely in a different position from that perspective. What's also interesting is that they're more like the generation from World War II, or what we would call baby boomers traditionally. Even though when they were surveyed that almost 20% are trying to say that they are trying to outperform the overall stock market with their investments, it doesn't make a lot of sense that millennials hold more cash in their portfolios than any other generation. And if you've taken a look at what the interest rate on cash is, it's definitely not keeping up with what the market has been doing over the past decade. They are more open, they are more positive in talking and having conversations about savings. So when you are having conversations with your employees, oftentimes they have told the folks doing education meetings for the retirement plan of what they're looking for. A lot of times they do talk about why they aren't saving, because they are trying to pay off their student loans. They do have to pay for their own housing and basic needs, but they do want to save at the same time, but they're trying to find something that will interest them in saving. Naturally, a match or profit sharing or any sort of those options in a plan help, but not every plan has that. So how do we go about in getting this generation interested? And that's where social investing comes in. Now, in the prior slides, recruiting and retention are definitely important. And if a conversation is coming up with a potential recruit, and naturally you are talking about benefits, talking about something that is interesting to them would be helpful within the context of the retirement plan, whether it is a match or profit sharing. But then also talking about a socially responsive fund would help as well. being that 2/3 would likely switch for better retirement benefits. That's pretty powerful, and naturally it's higher than what you see here on the chart, which is Generation X and the baby boomers as well, with half of the participants in the study saying that they have made investment decisions based on social factors or social values to them. So then what is social investing? It's helpful to know that millennials are twice as likely to buy or invest in companies that have a focus on social, environmental, or sustainable outcomes. And that's where Neuberger has put together a lot of information regarding what is ESG. And ESG is a broad term. It's environmental, social governance. It's kind of the umbrella term for what you might hear as social investing, but there are a lot of different factors when it comes to ESG. And the one thing I encourage you to remember is when it comes to ESG investing, these are material financial factors that a money manager would look into that have an effect on profitability, on growth, and of course, sustainability. So when we think about ESG, naturally the E part is environmental. And if you ask the question, do you want to invest or buy a company that has an interest in clean water or clean technology and innovation, you're pretty much going to nod your head yes. Would you want to buy a company that has an interest in employee health and safety, good labor relations with their employees, diversity on the board of directors and employees? And when you take a look at this slide, you want to think about what is the issue on the left, and then what is the financial material effect on the right that it has on the business. So more ESG factors, community impact, sustainable supply chains, product integrity. And when you think of governance and disclosure, it is corporate governance and disclosure. Executive compensation tends to get a lot of press on what the executives and how much money they are making and how aligned that is with the interest of shareholders. So with the issue and the material effect, these are all fundamental business issues that are rooted in sustainability. One statistic that I find very interesting is when you think of the S&P 500, 500 largest companies in the United States, 85% of these companies have what's called a CSR report. So it's a report of corporate social responsibility. And these very large companies put this report out because investors want to know what environmental, social, and governance impacts have on the state of their business. So as much as ESG investing has doubled over the past 5 to 6 years, these are material interests, again, that have an effect on the financials of a company, but it's what individual investors and very, very large investors want to know about as well. So when we take a look at the benefits and impact, this is just an example of sustainable supply chain. Naturally, any sort of business with the supply chain, you want it to be reliable, you want it to be efficient, you want the products to have integrity and then also be compliant, because when there's any sort of issue with any sort of these business issues, it's going to have an effect on the business activity. Human rights is an issue that we see definitely a lot in the press, and it really has a lot to do with fair labor practices, discrimination, health and safety, and also has to do with a lot of these issues in outsourcing as well. If you remember 5, 6 years ago with some retail manufacturers having employees overseas, there was a lot of uproar with respect to how these employees are being treated. And these are issues that do have a material effect on earnings, but then also the headlines might not be good for the companies who are public in the United States as well. And so a lot of research goes into, well, what are these companies doing in treating all employees globally well and treating them fairly. And naturally, energy efficiency. If you can buy company A who has higher efficiency standards or has a plan in place to be more efficient, that is going to result in using less energy or using energy in better ways that ends up in higher productivity as well. So these are all issues that are important to investors. And sometimes they're having questions about, all right, if we take a look at certain companies that focus on environmental and social governance, does that mean there's a trade-off in financial performance? And studies have shown that answer is no. High sustainability companies can outperform on an ongoing basis. The study was done by the Harvard Business Review, and that a focus on sustainability shows that in this particular study that it's accretive. It adds to financial performance of about 20% of the overall performance of CEOs that focus on these factors. And this is just going back from 2007. If we did take a look at socially responsive or environmental social governance funds versus the S&P 500, which is also inside of the Morningstar large blend box, that you can make money, that we have kept up and have beaten the respective index and the peer group over a period of time. So at Neuberger Berman, we know a lot of this information because we have had a fund called the Socially Responsive Fund for the past 20 years. We were a pioneer in that a client 20 years ago asked us to manage money in a specific way. So without going too far, this is definitely not a product pitch at all. Just the research that we have available to our investors, and definitely to Doug and his colleagues at Beacon Pointe, we're able to show how we add value as active managers in the research that we do, and then also the content that we can provide to you when considering adding a social fund to your plan. These are issues that are important to a large group of investors. Millennials now comprise 25% of the U.S. population, outnumbering baby boomers. And if we are able to give them an option inside of the retirement plan of which they're interested, they're more likely to purchase that option to not only help them retire comfortably and on their own terms, but then to also give them something to feel good about that they're investing in. So I want to know if there are any questions.
Thanks, Jay. We actually do have a couple questions coming in. The first one is, how many of these social funds should I be offering in my plan?
We've seen definitely from one fund, and I've worked on plans where there is a social fund in almost every category. So it really depends on what your goal is. I think when you take a look at your own culture at your company, if sustainability is part of that culture, maybe surveying the employees as to how interested they are. I'm a proponent of diversification, and that means diversification just across the board, which doesn't mean that you should necessarily have a social fund in every asset category. That may be a little too much, but depending on if you're working with Doug currently, what your goals are, and if you want to offer one fund in the domestic style box and maybe one fund in fixed income or international, you'd be covering your bases pretty well with just those three asset categories for a social fund.
Another question just came in. They've heard the term of impact investing. What exactly is impact investing?
Definitely under the umbrella of ESG investing. It's something where you're trying to measure the outcome of how the investment generates a social and environmental impact alongside some sort of financial return. The term is naturally used fairly loosely, and oftentimes impact investment is in a private market, so it's not a public fund. One example of that is if there is a real estate developer looking for investors, and part of that real estate development, there's a requirement of, say, 10% of the housing to go to low-income housing. So that's a social impact, and there are certain targets for that. So it has to do with what is the result of the investment, and more so it's seen on the private side than you would find inside of a mutual fund. But mutual funds should be able to give you some information on some of those measures of social and environmental impact on whether it's carbon footprint or gender diversity on the board. Your investment should be able to provide you some information on that.
Perfect. And then last question coming in before we wrap up. Once I put, one or multiple of these social funds in my plan, how do I educate my employees on these options?
That is something where more and more investment companies, and Neuberger included, are providing educational tools. Mostly, some of these tools are online, but in the case of working with you, Doug, that we have participant education materials to help educate on, well, what is ESG, what is impact investing, and a lot of those processes start from the top down with educational tools that are provided to you, the employer, and the committee making the decisions for the retirement plan. So you just have to ask what educational tools are available to help educate the employees that are specific to the investments inside of the plan and part of the decision making that was put into why this specific fund or funds were put in the retirement plan. So pretty much you just ask and you hopefully should get the information you need to help educate your employees.
Perfect. Well, that brings us to a conclusion of our Beacon Pointe Fiduciary Point of View webinar. And on behalf of Beacon Point Advisors, I'd like to thank you all for joining.